Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And this week, well, we're diving into what feels like a major contradiction in the UK financial world.
It really is. You've got all this political talk about growth, promises being made, but then you look at the actual economic picture, and it's pretty stark. Austerity seems much more likely.
Stark is the word. Sources are talking about a really significant fiscal black hole for the Treasury. Could be 18 billion, maybe even up to 28 billion they need to find.
And we all know how that usually gets filled, don't we? Yeah. Stealth taxes.
Exactly. Like freezing income tax thresholds.
Yeah.
That alone is expected to pull, 1.3 million more people into higher tax bands and rake in an extra 10 billion a year.
And businesses are feeling this directly. I mean, the latest surveys show business inflation expectations jumping to 3.7%.
Yeah.
Overall expectations are at 3.4%.
That's the highest since December 2023, right?
It is. And at the same time, hiring intentions are the weakest they've been since 2020. So a real squeeze.
You really hear that squeeze in the quote from the Greg CEO, Roisin Curry. She was talking about an unexpected national insurance hit.
Oh, yes, I saw that.
She said, and I quote, "It's quite hard to plan and manage a business when you have a 20-pound-a-meter that you hadn't predicted." I mean, that sums up the pressure perfectly, doesn't it?
It absolutely does. And that brings us to the core paradox for this deep dive. Because against this really tough economic background, regulators, specifically the FCA, seem to be moving the other way.
The great softening, as we're calling it.
Exactly. They're talking simplification, reducing the administrative burden. So the big question for everyone in risk and compliance has to be, is this smart, pragmatic policy to encourage growth? Or is it actually, a dangerous step back just when stability is needed most?
Okay, let's unpack that great softening then. Starting with the consumer duty, it feels like a major shift after years of intense focus on getting it implemented.
It is a pivot, definitely. And what's really quite remarkable is the FCA's own language. They've publicly admitted the duty created, and this is their phrase, excessive burden.
Really? They said that.
Explicitly. And that it led to firms gold plating requirements, basically, going further than the original outcomes-focused intention. You don't often hear a regulator being quite that self-critical.
That is unusual. So it's not just talk. There's actual action happening.
Yes. Measurable action. They're trying to make things more flexible, more predictable for the sector, which, as we said, is under pressure. The most concrete thing so far is decommissioning some data returns.
Fewer forms to fill in.
Essentially, yes. We're talking about at least 20,000 fewer submissions a year across the board. That frees up significant compliance time and resources.
Okay, 20,000 fewer submissions sounds good. But is that it?
No, they're looking longer term, too. They're planning consultations for 2026 on some really tricky areas. Things like distribution chains, how the duty applies to non-UK customers. That's always been a big gray.
Ah, the cross-border issue.
Precisely. And even reviewing core definitions, like what exactly constitutes a retail customer. These are things the wholesale side has been grappling with.
But hang on, you called it pragmatic. Isn't cutting 20,000 data points potentially risky right now, with consumers feeling the pinch from inflation and those stealth taxes? Are we losing vital oversight?
Well, that's the tension, isn't it? But the SEA's argument, or justification, is that this softening comes from a position of strength, not weakness. They're pointing to successes.
Such as?
Well, they cite stopping firms double-dipping on fees for cash holdings. They reckon that saved consumers about £10 million a year.
Okay.
And maybe more relevant for our listeners, the number of upheld complaints about unsuitable advice has dropped quite significantly. It was 39% back in 2022, now down to 26% in 2024.
Right, so the argument is the core principles are embedded, the culture shift has started, so now we can trim the bureaucracy.
That seems to be the logic. If they cut the unnecessary reporting, maybe firms can focus resources elsewhere, perhaps on innovation, like tackling that advice gap for the, 15 million undersavers in the UK?
That would be a positive outcome.
It would. But, while regulators are redrafting rules, consumer behavior is changing even faster. It's almost outpacing regulation.
Which takes us neatly to the payments tipping point. You mentioned a really stark statistic from UK Finance this week.
Yes, this one is undeniable, 50%. 50%. Half of all UK adults now regularly use mobile contactless payments. Think Apple Pay, Google Pay. That's up from just a third last year. That is critical mass.
Wow, half the adult population. That's a huge behavioral shift in just 1 year.
It really is. And you contrast that with cash. It's just collapsing. Cash is now down to only 9% of all payments.
9% below direct debit.
Below direct debits, below faster payments. And the forecast is it could drop to just 4% by 2034 when something falls into single digits like that.
The infrastructure starts to look very expensive.
Exactly. How can banks keep justifying the huge fixed costs of cash handling ATM networks when usage is plummeting like this? It stops being just about choice and becomes about, well, infrastructure viability and social responsibility.
Well, that consolidation risk is very real, isn't it? If banks pull back on cash infrastructure, the financial inclusion arguments become incredibly potent. It flips the risk calculation completely.
It does. And other payment methods are surging too. Faster payments is now the second most used method overall, driven by mobile and online banking.
And buy now, pay later?
Growing incredibly fast, used by 1 in 4 adults, now 25%. That's aggressively eating into traditional credit models, adding another layer of complexity for regulators trying to simplify elsewhere.
Okay, so systemic changes are happening. But let's pivot now to some really acute, immediate operational risks hitting companies right now. I'm thinking of the Jaguar Land Rover cyber attack.
Ah, yes, the JLR situation.
Yeah.
It's a perfect, if painful, example of how an abstract cyber risk becomes very real, very quickly, and turns into acute credit risk for banks.
Production halted for over a month, wasn't it?
It was. But the impact wasn't just JLR. The shockwaves went straight down the supply chain. Smaller suppliers, specialist parts makers suddenly faced a massive liquidity crisis. They were pushed right to the brink.
And the human cost you mentioned earlier, that quote was really telling.
It was striking. Suppliers needing emergency loans, being quoted interest rates like 16%.
16%.
Yes, but the banks were demanding personal guarantees, asking owners to put their family homes on the line for a cyber attack they had absolutely no control over.
That really brings it home.
It does. We have to remember that quote from Michael Bees at Gen X UK. He asked, "Why should I put my business and family home on the line when I've done nothing wrong?" That question should be echoing in every commercial bank's risk committee. It demands a fundamental rethink of how supply chain and cyber risks are underwritten.
So, moving from that traditional corporate risk to the digital world, there's the ongoing issue of authorized push payment, or APP, fraud. The latest FOS data had some interesting points about challenger banks.
Yes, the Financial Ombudsman Service data. It definitely challenges that easy assumption that digital native banks are automatically safer or better at handling fraud.
What did it show?
Well, Revolut and Monzo actually topped the list for APP fraud complaints that ended up at the FOS. Revolut had 1,875, Monzo had 1,063.
And how does that compare to, say, a big incumbent?
Well, compared to Barclays, they have a much larger UK customer base, around 20 million, compared to Revolut's 12 or 13 million. Barclays had 11,161 complaints referred. So you see a higher concentration at the challengers.
Okay, that's interesting, but you said there was a real kicker in the data.
Ah, yes. The uphold rate. This is crucial for operational risk teams. For Monzo, the FOS upheld a shocking 41% of the complaints referred to them.
41%, that seems incredibly high.
It is very high. Compare that to Revolut at 30% or Barclays at 31%. An uphold rate that high suggests potentially quite deep issues, either with their initial fraud prevention or, perhaps more likely, how they handle complaints and remediation afterwards.
Because a high uphold rate means the ombudsman is consistently siding with the customer against the bank.
Exactly. And that means mandatory payouts, reputational damage. It's costly. To be fair, the challengers know this is a massive issue. Revolut, for instance, has highlighted huge investments in fighting financial crime. They say over a third of their entire global workforce, that's over 10,000 people, is focused on it now, using sophisticated AI.
So for them, fraud isn't just compliance, it's a core operational cost, almost existential.
Fundamentally, yes.
Right. That focus on the operational realities of digital finance brings us nicely to our final section, the future of money and what central banks are thinking. Stablecoins first.
Yes, the Bank of England Governor, Andrew Bailey, was very clear recently. He basically said it's wrong to be against stablecoins as a matter of principle. So the door is open to the technology.
But there's a but, isn't there?
A very big but. He made the regulatory path crystal clear. Any stablecoin that becomes widely used, systemic, must be regulated exactly like a bank. No shortcuts.
Meaning what specifically?
Meaning mandatory depositor protection schemes. And needing access to the Bank of England's own reserve facilities. Essentially, if you want to play a major role in payments, you accept bank-level responsibility and oversight. Stability first.
Stability first. Innovation second. Non-negotiable.
That's the message.
And while that's happening, what are the traditional players doing? Swift has that blockchain project, right?
Yes, Swift is working with, I think it's over 30 big global banks. JP Morgan, HSBC included on a blockchain-based shared digital ledger. The aim is instantaneous cross-border payments, trying to modernize the old rails.
But there's some skepticism about that.
There is. Some critics are framing it as the dying grasps of financial fossils trying to react to the crypto world, which they can no longer ignore. Swift really needs to show practical, real-world benefits quickly to counter that narrative. It's a tough challenge, integrating new tech with legacy systems.
Okay, finally then, let's look at the PRA. There are new liquidity rules coming for insurers, PS 1525. Why should banking professionals pay attention to insurance rules?
Because these rules are a direct result of recent crises, and they act as a clear signal, a blueprint, if you like, for wider supervisory expectations.
Which crises are we talking about?
The 2020 dash for cash during the pandemic, and definitely the LDI crisis in 2022 following a mini-budget, those events expose serious gaps in liquidity management and reporting.
Especially around complex things like derivatives, margin calls, collateral management.
Precisely. So these new PRA rules for insurers demand much more granular reporting. Things like cash flow mismatch analysis, short-form daily stress reports focusing specifically on those areas: derivatives, collateral movements under stress.
So even though these rules are technically for insurers, the logic applies across the board.
Exactly. The focus on detailed daily stress reporting in these specific high-risk areas for insurers is almost certainly a preview of what the PRA will expect from banks down the line. Banks need to demonstrate that same level of granular, real-time control over liquidity, especially under stress. The implementation for insurers isn't until September 2026, but the direction of travel is clear.
Okay, so this week really has crystallized that central tension, hasn't it? Regulators trying to ease the burden, the great softening while the economy bites hard, costs rise, and the operational risks just seem to get more intense.
That paradox holds. The FCA simplifies conduct rules, aiming to reduce burden, but at the same time, the real-world cost of operational failures, like we saw with JLR, or the fraud figures at Monzo, seems to be increasing, both financially and in human terms.
Which leaves us with a final thought for you, our listeners. As regulators rightly demand bank-like resilience, things like depositor protection, for new digital players like stablecoins, how does the industry ensure the rapidly escalating costs of these acute operational risks, the JLRs, the cyber attacks, is properly priced into lending decisions and compliance frameworks, especially when the conduct rules are supposedly getting simpler?
It feels like the digital and physical risk worlds are colliding, and our models need to catch up fast.
A critical point indeed. That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.